Picture this, two massive companies decide they want to merge. We're talking billions of dollars on the table. Lawyers, accountants, executives flying in from everywhere. And sitting right in the middle of the whole thing, some guy in a tailored suit who's been awake for 36 hours straight, running spreadsheets and making phone calls. That guy's bank just made $80 million from this deal. He personally pocketed in somewhere north of $500,000. And here's the wild part. He didn't start that company. He didn't invest his own money. He didn't even really take any risk. He just arranged things. Today, we're going to dive deep on investment banking, what these institutions actually do, the specific ways they generate billions in revenue, why the people who work there get paid more in a year than most people see in a lifetime, and whether any of it actually makes any sense. Let's get into it. First things first, investment banks are not your regular bank. You don't walk into Goldman Sachs and ask for a savings account. There's no ATM, there's no tellers. These institutions exist to serve one type of client, big money. Corporations wanting to raise capital, governments needing to issue debt, billionaires trying to do deals. The names you've heard, Goldman Sachs, Morgan Stanley, JP Morgan, Rothschilds, and their entire business model is built around one core idea. They connect people who need capital with people who have it. And every single time that connection happens, they take a cut. Now, the way they make money breaks down into four main buckets: advisory, underwriting, trading, and asset management. So now I'm going to go through each one because they're all kind of ridiculous in their own way, but I'll break it down. Advisory is the most glamorous part of the industry and honestly the one that makes the least amount of sense until you understand it. Say company A wants to acquire company B. This is a massive deal. Enormous amounts of money involved. Complex legal structures, regulatory approvals, shareholder votes, due diligence on every corner of both businesses. Company A doesn't want to figure all of this out themselves, so they hire an investment bank. Goldman Sachs sends in the team. They run valuations, figuring out what company B is actually worth. They build financial models. They advise on how to structure the offer. They run negotiations. They manage the whole transaction from start to finish. And if the deal closes, which is the key part, Goldman gets paid a success fee. On a $10 billion deal, that fee can be anywhere from $50 million to $150 million, just for facilitating the transaction. No capital at risk, no product being built, pure expertise, relationships, and execution. Now, this is called an M&A advisory, mergers and acquisitions. And this is the most prestigious, most competitive, most high pressure part of investment banking. The analysts doing this work are routinely working 80, 90, 100-hour weeks, and it's genuinely brutal. But when your bank is pocketing 9 figures from a single deal, you understand why the machine keeps running. Now, let's talk underwriting. This one's a bit more technical, but just stick with me real quick. Say a company decides it wants to go public. They want to do an IPO.
An IPO is an initial public offering. It's the first time a stock is offered for sale to the general population. Now, as the firm taking the company public, we set the initial sales price, then sold those shares right back to our friends.
They can't just walk up and be like, yeah, we'd like to sell shares now, please. They need an investment bank to manage the whole process. And here's how underwriting works. The investment bank agrees to buy all the company's newly issued shares at a set price. Then they immediately turn around and sell all those shares to institutional investors. So that's your pension funds, hedge funds, asset managers at a slightly higher price. The difference between what the bank paid and what they sold for is called the spread. And that spread goes directly to the bank. On a $1 billion IPO, the underwriting spread is usually around 5 to 7%. That's 50 to 70 million from a single listing. They do the same thing with debt. When a company or a government wants to issue bonds to raise money, the investment bank underwrites the bond issuance. Same concept, different instrument, same fat margin. Now, here's the thing that makes this kind of interesting. The bank is technically taking risk here. They've committed to buying shares at a set price before they've confirmed investors will buy them. But in practice, the bank has already lined up investors before the deal closes. They do what's called building a book, quietly gauging investor appetite before officially committing. So the risk is real in theory, but mostly managed in practice, so it's very smart business. Investment banks also have massive trading desks, stocks, bonds, currencies, derivatives, commodities, and the way they make money is through something called the bid-ask spread. Here's the simple version. When you want to buy a stock, the bank will sell it to you at a slightly higher price than what it's currently trading at. When you want to sell, the bank will buy it off you at a slightly lower price. That gap, the spread, is the bank's cut. On one transaction, it might be tiny fractions of a cent. Multiply that by millions of transactions across every single asset class, every single day, it adds up to billions. Now, it used to be even more lucrative because banks could also do what's called proprietary trading, using the bank's own money to make speculative bets on markets. Some of them made an absolute killing doing this. Some of them also blew up. The 2008 financial crisis, one of the worst economic events of our lifetimes, had a lot to do with these banks taking massive proprietary bets that went catastrophically wrong. In the aftermath, regulators came in and passed something called the Volcker rule in the US, which largely banned banks from using their own capital for speculative trading. The trading desks still exist, they still make billions, but the pure casino with the firm's own money era is largely over, at least officially. The fourth revenue stream is asset management. Many investment banks run enormous asset management divisions. They manage money on behalf of pension funds, sovereign wealth funds, university endowments, ultra high net worth individuals. The fee structure is beautifully simple. They charge a percentage of assets under management every year, typically somewhere between 0.5% and 1%. Now that sounds small until you realize these firms are managing hundreds of billions of dollars. BlackRock, the world's largest asset management, manages over $10 trillion in assets. Even at 0.25% fees, that's $25 billion in annual revenue before any performance fees, before anything else. And the magic of this model is that the fees roll in whether the markets go up or down. The clients bear the investment risk. The bank collects the management fee regardless. It is one of the most defensible business models in all of finance. Alright, let's talk about the part that everyone actually comes here for. How do the people at these banks actually get paid? Because the bank making billions is one thing, but individuals walking out with 7-figure paydays in their 20s, that's a different conversation. Here's the structure. Junior analysts, fresh out of university, 21, 22 years old, start on a base salary of around 100k to 150k at a top firm, but on top of that base comes a bonus, and that bonus can be 50 to 100% of their base salary. So your 22-year-old first year analyst might take home $200,000 to $250,000 in total in their first year out of college. Move up to associate level, maybe 3 or 4 years, and the total compensation starts hitting $300,000 to $500,000. Make it to vice president or the managing director, we are talking 7 figures comfortably. The absolute top producers at these elite banks, the rainmakers who bring in the billion-dollar deals, can make $5, $10, $20 million in a single year. Here's the catch, and it can be a big one. You are working 80 to 100-hour weeks. That is not an exaggeration. These are the leaked interval surveys from Goldman Sachs where a first-year analyst reported working 95-hour weeks and described their physical and mental health as deteriorating. You are selling your mid-20s to the institution, and most people burn out within 2 to 3 years. But the ones who survive often leave to go start hedge funds or private equity firms, and they make even more money. There's a type of person built for this world, and there's a type of person who isn't. Here's the thing they don't really teach you in any finance course. The actual skill that creates generational wealth in investment banking, especially at the senior level, is not financial modeling. It's not valuation techniques. It's not really deal execution. It's the relationships. The managing directors, the people at the top of these firms, their primary job is to know the right people. CEOs, CFOs, board chairs, founders, because when a company decides it wants to do a $5 billion acquisition, they're not Googling investment bank near me. They're calling the guy they've been having dinner with for the past 10 years. That's the job at the top level. Pure relationship capital, which is also why investment banking is one of the most notoriously difficult industries to break into without the right pedigree. Target universities, internships, knowing someone who knows someone, technical skills can be learned. The network takes years to build. So let's bring it all together. Investment banks make their money through 4 main streams: advisory fees on mergers and acquisitions, underwriting spreads on IPO and debt issuances, trading desk revenue from bid-ask spreads across global markets, and asset management fees that compound quietly every year regardless of market conditions. Now you know exactly how they get paid and how they work. Subscribe, drop a like, and I'll see you guys in the next one.